If I were starting to invest in real estate in 2024, here are the 3 investing strategies that I would focus on. These are the 3 strategies that I started out with that helped me build a solid foundation and accelerate my path to owning a $7 million portfolio. Now, you don't need to copy these exact ideas because you might have a different risk tolerance, or you might have other types of real estate opportunities available to you. However, what you will learn is the fundamental ideas that made these strategies work in the first place. And then you can take these lessons and principles and apply them to your own personal situation. And if you get it right, you'll start generating real, sustainable, passive income, scale, and truly be on a path to early retirement. The first strategy that played a crucial role in my journey was investing in multifamily properties, specifically student housing. My first purchase ever was a student rental, and there were many reasons for it that some people just don't realize. As a college student myself, I only looked for properties that were close to campus, affordable, and had a solid amenity. And whenever I rented a place, I was always sharing with other students to keep my overall costs down. And this is when I realized property owners were able to collect more rent by renting out individual rooms instead of renting entire houses. This is a win-win as owners make more cash and students actually live in a nice house and reduce costs by sharing. I also realized that the houses near universities and colleges were always in demand, as year after year, new students come into the market and universities typically don't shut down, making this somewhat a recession-proof investment. There's also a safety factor when renting to multiple rooms or having more units. The potential for rent to go to zero is reduced. If by any chance I had a vacancy, I still had other rooms rented, and this was very attractive to me as a young and aggressive investor. Putting all the pieces together with well-maintained, strategically located properties, I was able to attract a steady stream of tenants year after year. This strategy generates a stable cash flow and also gives you the potential for rent increases as the demand for student housing always rises. I was making 20 to 50% more profit compared to other housing options I had available at the time. Student rentals and multifamily units can be a great way for you to accelerate your cash flow, all while learning the skills to manage properties and multiple tenants, which is a skill you'll use later when you scale and have multiple properties. And the best part is, the strategy inherently reduces your risk of vacancy and rental losses. The second strategy I implemented was investing in pre-construction condos. Now this might sound risky to some, but hear me out. My approach was to carefully research cities that were growing, areas with higher immigration, infrastructure upgrades, new business developments, or plans for new transit lines. By locking in a price before these areas hit their peak, I managed to secure properties that appreciated substantially by the time they were built. You're essentially locking in today's price and letting the builder take the time to build your land while appreciating over time. In my case, my condo took over 3 years to build, and a lot happened to the market in that time. And the best part is, I didn't even need a full down deposit to get into the game. When I purchased my first pre-construction condo, I was able to break down my deposit into smaller chunks. 5% now, 5% in 6 months, 5% in 1.5 years, and the last 5% was when the construction was completed. I didn't have to worry about finding any tenants or closing costs till years later when the construction was completed. My money was invested, locked in, and appreciated every year without lifting a finger. This strategy is truly a game of patience, and the key here is to find a reputable builder, know the location you're investing in, and having an exit strategy. The third is the Bur Strategy, which stands for Buy, Rehab, Rent, Refinance. This strategy can be a game changer, but there's some risks here that you should be aware of that I will explain in a minute. My focus was finding properties that were structurally sound, but needed cosmetic updates and had the potential to add more units, either in the basement or a detached ADU. Think about the student rental case. One of the projects I did was buying a place near college that had 3 bedrooms, a large family room, and an unfinished basement. I was able to legally convert this into a 2-unit, 7-bedroom house. My cash flow increased substantially, and the value of a renovated duplex was well over the cost of the renovation because I was situated in a great city near a college. I made my money back plus more in equity. This strategy is about finding undervalued properties, renovating them to increase their value, renting them out for cash flow, and then refinancing to pull out most of the initial investment. By pulling that new equity out, I was able to reinvest that capital into the next property and continue scaling my business exponentially. The best part is the money you take out is tax-free. I will say though, sometimes it's better not to refinance. I have properties where I finished the renovation, improved my cash flow by thousands of dollars, and just kept going. It all depends on the math and your overall strategy. Now, this strategy only works if you have a good eye for potential, can effectively manage projects, and have a strong understanding of the after repair or market value of the house you are renovating. The key here is working with a very strong real estate agent, a general contractor that will complete the project in a timely manner. You will only be successful if you have a strong team around you. You need to be able to find these distressed properties and make sure you have a budget that will cover the renovation and any potential hiccups. Leave a comment below if you want to learn more about this strategy or any of the other ones I talked about. Now let's talk 2024. And what's the same and what's different? Well, to me, I would say mostly everything is the same. To get into real estate, you will need a solid credit score, work history, a solid investing strategy, and a down payment. This has not changed at all. Credit is super important because if you don't have a good credit score, you won't be able to qualify for a loan, or you'll be getting a loan with a much higher interest rate, which will just kill your profitability. The easiest way to increase your credit score is having multiple credit cards that you pay off consistently. And in general, most lenders want to see 2 years minimum of work history. This also hasn't changed. The strategies I outlined are very viable. The key to all these strategies was that they helped accelerate and maximize cash flow and profits, which I could then use to buy even more properties, all with the least amount of risk. And if anything, these strategies are even more relevant in today's market. As we all know, prices have increased substantially over the years, and simple cash flowing properties may feel harder to find. The only real difference in today's world is the down payment. The price of houses are higher than they were when I started. When I started, average house prices were half of what they are today. But even back then, I was always buying in that high time. I remember talking to my mentors and asking who in their right mind would buy this house for $440,000, or who would buy this pre-construction condo for $350K. There's no way it could go any higher. Should I really do this? Well, fast forward to today, and both houses are more than double. Now, salaries have not gone up to keep up with these prices. So yes, there is a difference in today's market, but the deals are still there, and you just have to be more intentional about collecting that down deposit. You need to get creative. On your savings plan, get aggressive. Because I'm telling you, the deals are there, and there's money to be made. My latest purchase is giving me a 20% cash on cash return, and that is not even including the potential for the price appreciation in the years to come. So if the down payment is your only hurdle, check out this video if you want to learn how I saved for my first down payment and invested in my first rental property.